Well, with the continuing global financial issues, whether you call it a crisis or not, what it means is the returns that companies have are not necessarily as high as they were in pre-GFC boom times. It means the returns on superannuation mean that less money is in our asset base for that time when we might want to retire. To talk some more about superannuation funds and their returns, Gavin Martin from Cornerstone Wealth is with us once again. Hi Gavin, welcome back to 2020.
G'day Neil, it's great to be with you, and it's been a challenging year in terms of financial markets, the last financial year.
Gavin, and this is, I know, a topic that you love to talk about, and one that affects all of us, and that is superannuation funds, because when we look at the details of the funds that our own superannuation might be invested in, sometimes the returns are just not there in the way that we had hoped.
Exactly. If we look at the average balance fund for the last financial year, the 2011-12 financial year, and most people wouldn't have their statements yet. Not all the funds have reported their earnings for the year, but it's generally thought that the return on an average balance fund will be around zero, or possibly a little bit above, possibly a little bit below, depending on what your particular option is. So it triggers the thought in people's minds, should I be in a different fund? Should I be in a different investment option within those funds, or should I just pull it out and put it in the bank? So there are a range of questions there that people will probably ask as they get their statements this year.
Is it possible, Gavin, that zero can look good? Because negative gains are really the downside of what happens in global financial crises that we've seen over and over these past few years. Zero could look good if you were thinking that other alternatives were going to lose your money.
Yes, exactly. Zero can look good because the balanced option is generally the middle of the road option in terms of risk and therefore return. So if you had a higher risk option, generally they're called something like growth or high growth or something along those lines. If you had a more risky option than the balanced option, you would have generally have been a negative return. So you would have received, less money, would have less money in your account than the previous financial year. So it really depends on what your investment option was. But yeah, exactly. Depending on what it was, you could actually be having a negative return. Therefore, if you're just getting a zero return, it's not so bad. But you could have potentially been in cash. You could have been sitting in cash within your super fund and returned potentially around 4 or 5%. So that's the dilemma. At this point in time, do people now move their fund to cash, or do they keep it in their current investment option? And there are a range of factors that we should consider when doing that.
A range of factors, and as you're talking now, there's a range of options, and sometimes there's a little bit of a psychological process, isn't there, that financial people put you through to say you are a high-risk person, or you're prepared to take high risks, or you're a very conservative person. If you don't really know where you are on that scale, how do you actually know which option you should take?
Yeah, it's a good question. There's this whole process, or often comes in the form of a questionnaire, which is called risk profiling, which gives you a sense of how much risk are you prepared to take, how much volatility in the value of your money are you prepared to see. And if there's a generalisation that we make, most men in a relationship, and it's a generalisation only, sometimes it's reversed, most men have a higher tolerance to risk than women, and but it's not the only factor that you consider. So you might consider how much risk you're prepared to take as your general personality traits is or stands. But then the other side of it is, how long have you got before you need to use the money? So what's your investment time frame? And then also, when are you going to use, if you're going to use all of the money in a relatively short amount of time, then you shouldn't be taking too much risk with it at all.
So you're saying if you're a younger person, probably it's best to be high risk. If you're an older person, you've got to be more considerate of what happens if there are losses, because you're going to access that money before too long.
Yes, you've hit the nail on the head there, Neil, because if you retire, people that have retired during these last few years of the global financial crisis, they're in a lot worse position because they're they're starting to draw on their superannuation assets or their retirement assets when there's a low point in the market, and there's lots of research to show that that really negatively impacts your long-term financial outcomes. It's always better to retire in a year where your assets are a little bit more buoyant. But what you can do there is you can either work a little bit longer if it's a solution that's open to you. You can draw a little bit less, and there's pension drawdown relief, so that this year, rather than drawing the full, if you're between 55 and 65 years of age, rather than drawing the full 4% from your fund, you only have to withdraw 3%. So you can do things like that to reduce the amount of loss in your fund. But really, one of the key things is to consider what is the right investment option within your fund for you.
Once you've made that consideration and you think you've got that right, and you still look at the returns and you say, well, it's either zero or in negative territory, I guess the other and potentially risky option is to actually do a self-managed super fund.
Yeah, exactly. One of the things that people often confuse is that superannuation is an investment in itself. And people say, oh, my superannuation performed terrible this year. What they're actually saying is the underlying investments within my super fund have performed poorly this year. But within a public offer fund, that's a fund that's open to anybody, or within a self-managed super fund, you can choose the underlying investments. So you could choose to be in a cash option or a cash-like option. One of the benefits of a self-managed super fund is that you can invest in any standard term deposit within that fund. So you could set up your own super fund. You can go to your local bank and you can take out a term deposit and earn the 5 or so % that you might get on a term deposit these days. So yeah, you can actually go do it yourself, but you're taking full responsibility. And the other thing that you need to factor in is the costs of operating that fund can often outweigh the benefits of control if you haven't got sufficient assets in the fund.
And of course, if you're managing your own fund, the risk you're taking is that experts were managing it before and they couldn't get a return, so it may be that you might be a little optimistic or over-optimistic about your own investment capacity.
Yeah, often we overestimate our ability to outperform the market, yes. And it is very difficult for professionals to do it, and sometimes that's why we take a more diversified approach to investing, taking the market return and not trying to beat the market, because often after we've taken out the fees for trying to do better than the market, we actually usually do worse than the market.
And Gavin, looking ahead, when you look at the circumstances around the world economically, how does the outlook look for through to the end of this year and beyond when it comes to superannuation funds? Are they likely to improve?
Yes, I think they're likely to improve, but it's interesting, Glenn Stevens, the Reserve Bank governor, was speaking in Adelaide recently, and he was saying that over the past few decades, maybe 10 or 15 years, the average growth rate per person in Australia has been about 6%. And he said this is unrealistic for us to expect this into the future. He said that we should expect half of that, or 3% growth per person into the future. So even though we may see some growth in the funds over the next 6 and 12 months, the challenge is, or the expectation that we should set, is that the growth is going to be a lot less than it has been in the past. So set those expectations now and try and plan your finances around that.
And of course, have a chat to your financial advisor, and they can take into account any personal circumstances that need to be taken into consideration. Gavin Martin is from Cornerstone Wealth. That's www.cornerstonewealth.com.au. Gavin, thanks for talking to us today on 2020.
Yeah, great to be with you, Neil.